Have you ever noticed a peculiar phenomenon in our economy? When prices for goods and services surge, it often feels like an overnight change, impacting your wallet almost immediately. Yet, when the inflationary pressures that drove those increases begin to subside, prices rarely seem to follow suit, stubbornly remaining at their elevated levels. If this feels like an unfair, one-sided equation, you're not alone, and you're certainly not imagining it. Inflation spikes, and almost predictably, prices across the board begin their upward climb. We see it at the grocery store, the gas pump, and in our utility bills. Then, when economic indicators suggest inflation is cooling or even receding, a different pattern emerges. Prices tend to pause, holding firm at their new, higher benchmarks. For consumers, this experience can be deeply frustrating and often feels inherently unfair. We absorb the increases without much choice, but rarely do we share in the relief when the underlying economic conditions improve. This asymmetry in price adjustments is a fundamental aspect of market behavior that impacts everyone, from individual shoppers to large-scale investors. Today, we're going to embark on an analytical journey to explain precisely why companies are so quick to raise prices during inflationary periods, yet become remarkably slower and often entirely unwilling to lower them once those inflationary pressures have passed. We will delve into the economic incentives, psychological biases, and strategic considerations that shape these critical business decisions. By the end of this comprehensive analysis, you will gain a profound understanding of the complex incentives that drive corporate pricing strategies. You'll learn why genuine price cuts are a rare occurrence, even after significant inflation. Furthermore, you'll discover why the common consumer expectation of waiting for prices to fall often leads to disappointment, offering valuable insights for managing your personal finances and investment outlook. This knowledge isn't just academic. It's practical financial literacy. It will empower you to better interpret market signals, anticipate economic trends, and make more informed decisions as a consumer, an investor, or simply an engaged citizen navigating the modern economy. We aim to demystify these economic forces, providing clarity where there often feels like confusion. Let's simplify the fundamental economic calculus at play. When a company's input costs rise, whether it's raw materials, labor, energy, or transportation, they face an immediate threat to their profit margins. To maintain profitability and ensure business continuity, companies typically respond by raising their selling prices. This is a direct, often necessary, reaction to cost-push inflation. However, the situation becomes far more nuanced when those input costs stabilize or even begin to decline. Lowering prices, at this juncture, introduces a new set of significant risks and strategic disadvantages for businesses. Once customers have accepted and adapted to a higher price point, reducing it is not always the rational or most profitable move from a corporate perspective. This seemingly simple incentive structure profoundly shapes pricing behavior, often in ways that most people, including many seasoned investors, might not fully anticipate. It highlights the strategic depth behind seemingly straightforward pricing decisions, revealing a complex interplay of economics, psychology, and competitive positioning. Understanding this core principle is the first step toward demystifying price stickiness. Consider a product you purchase regularly, perhaps your favorite snack or a household staple. When the costs associated with producing and distributing that item increase, its price at the checkout counter typically rises quickly and noticeably. But when inflation slows, or even when specific input costs might marginally decrease, the price often remains stubbornly high. From a company's strategic vantage point, lowering prices after they've been elevated presents several critical challenges. Firstly, it can inadvertently signal weakness to competitors, suppliers, and even investors. A price reduction might be interpreted as a sign of struggling demand, excess inventory, or a desperate attempt to gain market share, potentially inviting aggressive competitive responses. Secondly, reducing prices risks resetting customer expectations. Once consumers become accustomed to a lower price, it becomes significantly harder to raise prices again in the future, even if new cost pressures emerge. This can erode a company's long-term pricing power and make future profit margin management more challenging. It's a delicate balance between short-term sales and long-term market positioning. Finally, Lowering prices can reduce a company's future flexibility. In an environment where economic conditions can shift rapidly, maintaining higher price points provides a buffer against unforeseen cost increases or market volatility. It allows businesses to absorb minor shocks without immediately needing to adjust prices again, which can be costly due to menu costs, the administrative and logistical expenses associated with changing prices. Therefore, instead of lowering prices, companies often opt to hold them steady, preserving their strategic options and perceived market strength. From the perspective of the everyday consumer, this pricing dynamic undeniably feels one-sided and often deeply unfair. You, the consumer, are compelled to absorb the price increases when they occur, bearing the brunt of rising costs. Yet, when the economic tide turns and inflationary pressures recede, you rarely get to share in the relief through corresponding price reductions. This creates a palpable sense of frustration and can erode trust in market fairness. This frustration is not only natural, but also entirely understandable. It stems from a fundamental disconnect between consumer expectations of a responsive market and the strategic realities faced by businesses. Consumers often expect a symmetrical response. If prices go up with costs, they should come down with costs. However, pricing decisions are rarely, if ever, solely about fairness or immediate cost fluctuations. Instead, corporate pricing strategies are meticulously crafted around a complex interplay of risk management, predictability, and long-term market positioning. Companies prioritize stability, profitability, and maintaining their competitive edge over immediate price responsiveness to fluctuating input costs. Understanding this underlying rationale doesn't necessarily make paying higher prices any easier, but it does provide a crucial explanation for the observed market behavior, shifting the narrative from perceived injustice to economic reality. Economists have a specific term for this observed behavior: price stickiness. It describes the phenomenon where prices, once they have risen, tend to remain at their elevated levels, even when the underlying economic conditions that initially drove those increases have improved or reversed. This stickiness is a pervasive feature of many markets, impacting everything from consumer goods to industrial components. The reasons for price stickiness are multifaceted. Beyond the strategic considerations we've already discussed, there are practical and psychological factors at play. Lowering prices can often be a more complex and challenging decision for a company than raising them. This is especially true when there's lingering uncertainty about future costs or overall economic stability. Businesses prefer to err on the side of caution, maintaining higher prices to protect against potential future shocks. In an inflationary or post-inflationary environment, stability in pricing often feels like a safer and more predictable strategy than a reversal. Companies are wary of initiating a price war or signaling weakness, which could destabilize their market position. This preference for stability contributes significantly to the observed stickiness, making price reductions a rare and carefully considered move rather than an automatic response to cooling inflation. This deep dive into price stickiness helps us reframe a crucial understanding. Inflation slowing down does not, by default, translate into immediate or widespread relief at the checkout counter. This is a critical distinction that often eludes public discourse and consumer expectations. When inflation slows, it primarily means that prices are stopping their rapid acceleration. It does not mean they are retreating to previous levels. Think of it like a car's speed. Slowing down means you're no longer accelerating as quickly, or perhaps you're maintaining a steady speed, but it doesn't mean you're reversing. Similarly, prices might stop climbing at a steep rate, or they might stabilize, but they typically do not roll back to pre-inflationary benchmarks. This nuanced understanding is vital for financial literacy and managing expectations. Once you grasp this fundamental difference between inflation slowing and prices falling, your expectations can shift significantly. This shift can, in turn, reduce some of the frustration and disappointment that people often feel while waiting for prices to normalize or return to what they once were. It empowers you with a more realistic perspective on market dynamics and economic cycles, allowing for better financial planning and decision-making. The persistent rise in prices, even after inflation cools, is not merely a random occurrence. It's a predictable outcome driven by a complex interplay of corporate incentives, economic principles, and consumer psychology. On this channel, our overarching goal is to illuminate these intricate patterns clearly, calmly, and analytically. We aim to provide you with the tools to understand the economic forces shaping your daily life and financial future. We believe that informed consumers and investors are empowered individuals. By dissecting topics like price stickiness, we hope to foster a deeper appreciation for the economic realities that govern our markets. This understanding is crucial for making sound financial decisions, whether you're budgeting for your household, planning investments, or simply trying to comprehend the news. In future videos, we will continue to unpack why everyday costs behave the way they do, exploring other fascinating economic phenomena and their real-world implications. We'll delve into topics such as supply chain resilience, the impact of technological innovation on pricing, and the role of government policy in market stability. Your engagement fuels our exploration. We encourage you to actively participate in this ongoing educational journey. If there's a specific product, a puzzling price change you've observed, or an economic concept you've been wondering about, please share your thoughts and questions in the comments section below. Your insights help shape our future content and foster a vibrant community of learners. Don't let economic complexities leave you feeling powerless. Empower yourself with knowledge. Subscribe to our channel for more in-depth economic analyses and financial literacy insights. Hit the notification bell so you never miss an update that could impact your understanding of the market. Share this video with friends, family, or anyone you know who feels frustrated by persistent high prices. Let's collectively build a more informed and financially savvy community. Thank you for spending your valuable time with us today, and we hope you have a blessed and insightful day.